The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, actually realize this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks.
Alasdair Macleod explains that today's geopolitical tensions are not isolated events, but part of a larger global power struggle playing out through economics and financial markets. He warns that many investors are underestimating the impact this will have on inflation, which continues to slowly reduce the real value of currencies around the world. As inflation builds, Macleod argues that investors will eventually demand higher returns just to hold fiat currencies, but since most major currencies are facing the same pressure, trust in the entire system is starting to weaken. He also points out that global markets, especially equities, are beginning to lose strength, with Japan standing out as an early warning sign because of its important role in global capital flows. This shift is pushing more institutions away from paper-based assets and toward real, physical stores of value. According to Macleod, gold is increasingly being seen as the most reliable form of money in uncertain times. He highlights falling participation in futures markets alongside rising physical demand, especially from countries like China, as evidence that the system is changing underneath the surface.
It's clear to me that you could say this is almost a proxy war between China and Russia on one hand and America on the other, with Iran basically fulfilling the role of a successful Ukraine. And America will be driven out of that, there's no doubt. The consequences of this are that this is not going to end very quickly. I would say that for most of this year, Hormuz will be shut. I think that's got to be your working assumption. The consequences for prices are being underestimated. I mean, I'm just drafting an article on this, which I'll publish later on today on my Substack. But the IMF thinks that in the US, inflation will rise to 4%, CPI, but core inflation won't go above 3%. What? Yeah, this is, I think this is a measure, if you like, of where intellectually, the sort of the investment banks, the strategists, the investment strategists and the economists, all that's where they are at the moment. And they're having to rethink this. And the consequences obviously are very, very negative for currencies, because what we're talking about, what is inflation? If you're talking about inflation of prices, actually, it's loss of purchasing power of the currency. And it's that people, foreigners initially, will be looking for recompense for. If you're going to continue to hold dollars and its purchasing power is going down, then you're going to need a higher yield on your bonds or your deposits, or better returns on your equities, or whatever it is. Without that, you sell the currency down. But the problem is, what do you sell it for? Because all other currencies, all the G7 currencies anyway, are in the same boat. So you've got this sort of slightly unreal situation where everything is crashing except markets. But that will come, and I think that's going to happen, I think, in the coming weeks. I mean, you've already seen, for example, look at the Japanese stock market. That definitely is on the way down. I mean, you could argue how far down it'll go. That's not the point. But the point is that it's lost its upward momentum. And once it's lost its upward momentum, we're talking about the very minimum, a fairly significant correction. Other markets will follow, because Japan is the major exporter of capital to G7 nations, including America. I mean, in two ways. First of all, directly through its insurance companies and pension funds investing for higher returns. And also because the Bank of Japan suppresses interest rates. Their reference rate at the moment is 0.75%. And that's the highest it's been for 30 years. The carry trade on the back of this is enormous. It's just built up and built up and built up over time. So what we're looking at is Japan actually is sort of pulling the blanket out like that out of the whole system. And the whole system is going to collapse in effect. That's the risk. And I don't see anyone really understanding this consequences. And so what, I just asked a question, what currency do you get out of? Do you go into? Well, I mean, there's only one answer for that. And that is that as a foreign investor, foreign holder, whatever, of, say, US assets or British assets or whatever, you go back to your own currency. Because that for you is your risk-free position, because you account in your own currency, if you see what I mean. The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, have actually realized this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks.
Veteran financial analyst Alasdair Macleod argues that the real story is not what we see in paper markets, but what is happening in physical demand, especially across Asia. He highlights how countries like China and India are absorbing vast amounts of gold through savings programs and banking channels, where supply is often quickly exhausted due to strong and persistent buying. According to Macleod, this growing accumulation means much of the available metal is already effectively spoken for, leaving global markets increasingly vulnerable to shortages. He also warns that price movements in futures markets can be misleading, often reflecting short-term trading rather than the true state of physical scarcity. In his view, this disconnect between paper pricing and real-world demand is becoming more extreme as more buyers seek direct ownership of physical metal. Macleod further challenges common narratives around countries like Turkey, arguing that much of the perceived selling of gold is actually internal banking activity rather than large-scale liquidation into global markets.
The idea that the Turkish central bank has been selling gold is actually wrong. The whole of the gold scene in Turkey was a bit of a mystery. And some time ago, when I was in Istanbul at a conference, I spoke to some bankers about this, and I asked them to explain it to me. I can't remember the details too much, but I think very, very briefly, what happens is that the commercial banks have a lot of customers who own gold, and they store that gold with the banks. And that, if you like, works almost like an unallocated gold account, whatever. They take that gold and they deposit it in the central bank's vaults. The central bank returns that as if it was own gold. And it probably is, in the sense in that it is probably leased to the central bank for whatever reason against Turkish lira. So you've got swaps going on all the time. And so all you're seeing really is, and this is the difference between the way we account in the West. All you're seeing is the ebb and flow of gold between the commercial sector and the central bank. This is not gold which is going on to the international market because the Turks are trying to support the lira. I mean, I haven't seen them do anything really to support the lira. I mean, it's one of the worst currencies in the world. I mean, how do you explain a currency which goes down all the time, and yet they continue to accumulate gold, or appear to continue to accumulate gold, and then suddenly they turn around and want to support the currency by selling gold? Come on, this is nonsense, complete nonsense. So, I mean, I thought that's the first thing. don't be confused by this. Now, what we do in the West is, if, let us say, a central bank leases gold into the market, it records it still as its own gold. It doesn't record the leasing. But somebody else will record the leased gold as their own property, which of course it is in law. If you lease gold, it becomes your property during the duration of the lease. So you get double counting. You could almost say that the Turks they do it a bit differently, probably slightly more honestly than we do, in fact. So all this stuff about selling gold in order to whatever, is actually nonsense. They will keep control over it. I mean, it's as simple as that. It hasn't come onto the international market. So I think that's the first thing. The Chinese banks are now heavily restricting the availability of physical gold to their customers. Sorry, excuse me. The reports are that they've limited it to something like 600 grams, kilograms, I think, something like that. I mean, there is a severe restriction, and it's sold out within a minute of 9 o'clock in the morning. Bear in mind that household savings in China are roughly 30 to 35% of GDP. That means that every year, households are putting aside in savings the equivalent of $5 or $6 trillion. $5 or $6 trillion. Where does that go? Property? No. Yesterday's story. Stock market? Some may be. I mean, our stock markets have been rising and rising and rising. Shanghai did absolutely nothing, but it sort of doubled recently. So there might be a little bit of it going in there. The answer is that the majority of that has been going into bank deposits, because banks have been quite constructive, if you like, in terms of helping savings in an environment of declining interest rates, because the People's Bank of China has been lowering its reference rates quite severely. But all these banks offer at the same time gold accumulation accounts. So you can, as a household saver, if you like, housewife, whatever, you can tell the bank, I want to move 500 yuan a month into a gold accumulation plan. There's an awful lot going into these gold accumulation plans. Now, the reason that you don't really see this is that the gold that backs this doesn't leave the Shanghai Gold Exchange vaults. It remains within the system. The way the vaulting system works is that anything that comes out of the vaults, if it goes back into the vaults, it has to be recast to guarantee the purity of all the gold in the vaults. So there is absolutely, there is a disincentive, if you like, for the large Chinese banks to take gold out of those vaults. So they will back their gold accumulation plans by holding physical gold in the vaults. Now, I don't know whether they run a completely covered position. Probably not. I don't know. In other words, there might be an element, if you like, of unallocated, like it doesn't exist, backing these vaults. I mean, obviously it's unallocated because there's a huge great lump of gold in the vault here, backing accounts here. But we don't know that they're 100% backed. But you can see that there is a squeeze developing through, if you like, household demand, nothing else. And I think what goes on in futures markets and all the rest, it's just noise. It really is. Just think, $5 to $6 trillion equivalent. Got to find a home. And where else does it go? And that's why you've got to drift. I mean, gold is, you want gold in size, forget it. You're not going to get it. It's all gone. It's all sort of pre-demanded. You've joined the queue.
According to Alasdair Macleod, the current worldwide unrest is a component of a larger struggle for dominance amongst powerful nations like the United States, China, and Russia. He thinks that these conflicts will not end soon and will continue to put pressure on the global economy. He warns that markets are underestimating inflation, which is slowly reducing the real value of all major currencies. In his view, inflation means money is losing purchasing power, and investors will eventually demand higher returns just to hold it. But because all fiat currencies are weakening at the same time, there is no true safe currency left in the system. Macleod also points to signs of stress in global markets, especially Japan, which plays a major role in moving capital around the world. He believes changes there, including the unwinding of large investment flows, could trigger wider instability in global markets. As confidence in paper assets declines, he says investors are turning toward real money, mainly gold. He notes that even big banks are raising their gold price forecasts, showing that the system is already shifting in that direction. At the same time, falling futures market activity and strong physical demand, especially from China, suggest that investors are moving away from paper trading and toward physical ownership. Overall, Macleod believes these trends show the financial system is under serious stress, and gold is becoming more important as trust in fiat currencies continues to weaken. Thank you for watching, and see you in the next video.